Good evening, everyone. My name is Nikita Desai. I'm the Director for Policy and Corporate Programs here at the Korea Society. Thank you so much for joining us tonight. Welcome to those that are streaming online, listening by podcast, or viewing on YouTube as well. Tonight we present Economic Forecast 2016, Korea and its Neighbors. It's my pleasure to introduce our speakers, Mr. Rhee and Mr. Suttle. Mr. Changyong Rhee assumed his current position as the director of the Asia and Pacific Department of the International Monetary Fund in February 2014. Prior, Dr. Rhee was chief economist at the Asian Development Bank. He was the chief spokesperson on economic and development trends and oversaw the Economics and Research Department. Dr. Rhee has held many positions within the Korean government, including the Office of the President, the Ministry of Finance and Economy, the Bank of Korea, the Korea Securities Depository, and the Korea Development Institute. Philip Suttle is the Vice President and Director of Global Economics at Tudor Investment Corporation. Mr. Suttle joined Tudor in 2013, where he works in the Global Research Department and is responsible for the analysis of global economic trends and related policy issues, as well as the development of Tudor's new weekly publication, Tudor Market Notes. Prior to joining Tudor, Mr. Suttle was chief economist at the Institute of International Finance in Washington, D.C. He has held positions at Barclays Capital, J.P. Morgan Chase, the World Bank, Federal Reserve Bank of New York, and the Bank of England. Our moderator tonight is President Tom Byrne. President Byrne joined the Korea Society last year, following a long and distinguished career at Moody's Investor Service, and even more distinguished career working with Phil Suttle at the Institute of International Finance in Washington, D.C. He made me say that. Before I turn it over, just a few admin announcements. Please silence your cell phones. We've distributed surveys at your seats. Your feedback on this program would be very much appreciated. And please join us as members. Return to the Korea Society for the Political Forecast 2016 on February 25th, featuring leading experts Ralph Kossa, Victor Cha, and Scott Snyder. Now over to Tom. Please give everyone a warm welcome. Thank you so much.
Well, thank you all for coming out tonight. We're trying something new. We're trying polling questions, but we don't really have the right technology for that, the little clickers that you all vote on. So we did something else, I think, through the invite, the email invite. And I'll get to the polling questions when we come to the when we actually start the program. But before we start tackling the subject of the program, I wanted to start off with a question on asking. I'll start with Changyong and then turn to Phil. So looking back at 2015 and given the events, particularly in the markets so far this year, it seems like a long time ago, 2015. What's your assessment of how the global economy turned out in 2015? What went better than you expected, if anything, and what did not look so good?
Tom, thank you. First of all, it's my great honor to be here in Korean Society again, and thanks for the invitation. So let me start with the good news. To me, the good news, the first good news was faster than expected recovery of the United States economy. So that's a great thing. Second thing was the stabilization of the Greek problem, and we see some sign of the Europe is start to going out of the tunnel and then start to have a recovery. So advanced economies, I think we had some good news. Bad news was the emerging market, and due to its internal political problem and also some, the external environment, make some of the emerging economies such as Brazil and Russia had a much worse economic performance than we expected. And so overall emerging market has some downward trend. I have some mixed feeling about China. China's growth rate is slowed down from 2014 to 7.4% to the 6.9% 2015. It's a significant slowdown, but that slowdown was actually expected slowdown in their transition. So we are not surprised. But what surprised us is that the spillovers from that slowdown, we thought that the rebalancing of Chinese economy from the investment and the export-led growth to the more sustainable domestic growth will benefit its neighbor and then global economy. But we find that actually in the short term, we still believe it's a good thing for the whole world in the long term. in the short term, we find that the spillover from this rebalancing can have a negative impact to some countries, especially commodity exporters, and those countries will have a more trade ties with China. And even financial term, some strain in last August means that even though China's direct linkage with the global financial market is not that strong yet, but can have a larger impact purely because of its size. So that spillover was a little bit more than we expected, and that includes the commodity price decline. So those three things are my observations.
Okay, good, thanks. And Phil, so last year, what went better than you expected, and what did not look so good?
Okay, well, before I get there, once again, I should thank everyone for coming and thank the Korea Society for inviting me back, and in particular, thank my friend Tom Byrne, who has to be he's my first friend who I can legitimately call a president. So, it's a great privilege to have a president for a friend. But in terms of what went right last year, I'm not sure very much went right, to be honest. But and I agree with some of the points you made, Dr. Rhee made, that probably the thing that kind of looked like it was going to go very bad and actually end up looking much better was Europe. So the fact that Europe is still cohesive, at least as of today, I think is probably the biggest net plus. I think the other point you'd make is that, given how quickly the unemployment rate dropped in the United States, despite the apparent weakness in economic growth, I think we got, in some sense, some good news on the sort of growth inflation or operating level story, the NAIRU story in the United States, which is good news for in terms of sustaining the duration of the outlook. I'd have to say, to me, the two best things that happened in the world, I think potentially have a very long run payoff. So in that sense, don't move markets much, but I think are potentially quite important. And the first point is possibly a very controversial point, but I'll make it anyway. And it's frankly the reintroduction of Iran back into the international community. And I think the nuclear settlement that was reached at the end of last year, I think will be looked back on as a very positive, important development. And I think what caused it, which was fundamentally a change in attitude of Iran towards what it wants to do in the world, I think is part of the Middle East solution. Obviously, there's a ton of other things that are getting in the way of that at the moment. I'm sure we'll talk about those later.
Right.
But I think that was a plus. And then the other thing that happened, which I think is a plus with a very long run payoff, is the climate talks in Paris and the agreement there. Because I think from a long run perspective, especially as China becomes more of an industrial economy, and the carbon emissions become more of an issue globally, and I think that was potentially very good. But so it's kind of maybe we set the groundwork for some long run payoff. But I think last year was, and obviously going into this year was not full of positives.
Okay, good. Well, that's certainly taking a long term view, Iran, and climate warming. Being from a Korean perspective, we think of other sources of climate warming, thermonuclear.
Well, I raise it partly for that reason. I think there are positives.
My next question is about 2016, but before I ask it, can we turn to the first polling question, Peter? So the first polling question, we have two, one on the global outlook and one on Korea, is the greatest risk to global growth in 2016 is, and the winner is China. 46% of our respondees said continued slowdown in China's economic growth, followed by low crude oil and commodity prices, and then the Fed, Middle East, geopolitical, and other. I don't know if we have we collated what the others were. Are definitely a lot less of a concern. Well, with that in the background, my question is, the IMF's relatively new economic counselor and director of research, Maury Obstfeld, has said that 2016 will offer an abundance of challenges. So what are the key challenges that we need to pay attention to in 2016? Phil, why don't you
I assume we'll
start?
come to China.
Yeah,
somewhat
China's question
somewhat
number
separately.
three. Yeah, well, it's hard to separate
so-
China from anything
So
these days.
I'm going
right.
to try and stay away
Uh-huh,
from China
okay.
at least for a few minutes, and maybe come to the 23%
Right.
issue, which is the oil
Uh-huh.
story. And I think that's in the real time, I think that's possibly the most pressing concern that certainly markets have. And you say, well, that's a bit odd because we always used to worry about high oil prices as the big threat, and low oil prices were actually a benefit. And I think it's fair to say that that principle still holds unless they get too low. And I think we've had two episodes in the past, 1986 and into 87, and then more importantly, perhaps 1998, when we had quite a lot of global problems, not because of low oil, but associated with low oil. Of course, you could argue in 97, 98, it was really East Asia and Korea kind of helped causing the weakness in oil. This time around, I think the big concern is that the growth in production has been so astounding in the United States, North America more generally. And we've got a game of chicken going on between the established producers in the Middle East and the new producers in North America, and neither wants to blink. Each is, in a sense, trying to force the other out of business. And it's that game of chicken, I think, that is so worrying to the global outlook, because unless there's some kind of settlement, the two sides get together and agree to some production cuts, which is very unlikely. In a sense, one side has to win by forcing the other out of business. And in North America's case, that means widespread financial problems and bankruptcies in the oil sector, which can spill into other parts of the economy. And in the Middle East case, it's probably an even worse scenario in terms of political and economic instability. For what it's worth, I mean, we think ultimately it will be the North Americans, the high-cost guys who blink. But it's looking like it's going to take a while for that to happen. And ironically, easy money, which is an outcome of all this, in some sense helps keep the game going, because it's really got to be the financial rug that has to be pulled from underneath oil producers in the private sector to cut oil supply, and that's not going to happen in a very permissive liquid environment. So it's a very complicated story, but I think that to me represents a major downside risk in the near term.
Right. Okay, good. Do you want to tell us what your oil price forecast is for the end of the year?
Well, to be fair, Arrow, we have a guy who looks at this, and he's been saying for a year and a half that it probably has to get down towards $20 a barrel, which I think is turning out to be reasonable. But the problem is, in a market that is so fundamentally oversupplied, it's hard to see that any price is going to instantly clear the market.
Right.
So, watch the downside, I think, for now. Just having said that, my colleague, the same guy, actually sent me an email earlier today pointing out that the Economist magazine cover for this week is I can't remember what the title is, but it's basically I think a dinosaur shaped as an oil drilling rig, saying, oil is a thing of the past or something, oil's dead. The last time the Economist had a cover like that was precisely at the bottom of oil prices in 1998, early 99. So maybe.
Okay. That's, if you take that as investment advice, almost.
No.
Changyong, what's the what are the key challenges that we need to pay attention to in 2016?
Before I answer that question, can I just comment on his remark? Phil's remark on the Iran. I think that's very important for Koreans, because how this Iran sanctions, all these things will go, play in the future, and whether Iran's economic transition will be successful will be a great lesson, or even will be closely watched by North Korea, we hope. So if we have a very successful if Iran has a very successful transition to the global world, we really hope that it can give a right signal to the North Korea and maybe do the similar things. That will be good for South Korea too and the global world. So we are very much, that's a very important issue. As for the
North Korea does have military ties with Iran, so maybe it is looking closely at this.
I'm sure that they will closely, watch what's going on and how this process. And as for the great risk, as you mentioned, since we're going to talk about China separately, so let me focus on the 8%, the other 8%, which is Fed, U.S. monetary normalization. And now I think people think that if this process will be gradual. It's already expected. So in itself, especially if you think about the heterogeneous and the monetary policy of Europe and Japan, others, looks like the consensus is that the impact was probably smaller than we were feared before. But I have a slightly different opinion because even though its direct impact of U.S. monetary normalization may be small, but now I think it really causes some big uncertainty among the in financial market society in some sense because in the non-traditional QE monetary policy in the last 5 years, 6 years was uncharted territory. In the beginning, it was quite caused lots of uncertainty, but in some sense, people are now adjusted, and in the direction of the monetary policy was in some sense saving some mistakes of the many financial markets. So in some sense, it's contributing to the stability of the financial market. But now it's the beginning of the normalization, which is also from uncharted territory from this big liquidity to a more normalization. And it's people are very uncertain about it. So in that sense, if there is any small shock come from the real sector or even geopolitical shock or oil prices, seems that this kind of fear and the risk averseness in the financial market really amplify the shocks. So maybe the U.S. monetary normalization in itself may not have a direct impact, but it's underlying factors which can amplify any small negative shock in the global world. So that I think is one important factor to consider.
Okay, good. Well, I do have a question on the Fed liftoff. Why don't I turn to that, and we'll save enough time to talk about China, I think. Yeah. So the Fed's lifting off, and at least according to the IMF, global financial conditions are in general on a tightening path. How do you see this affecting global financial market and stability and economic stability in general? And then at some point we'll have to start working in Korea. You did give a reference to Korea with Iran. Phil, you had some pretty interesting comments on this concern about inflation, perhaps excessive concern about low inflation. Do you want to?
Well, I think it's fair to say that it's very difficult to imagine this tightening cycle looking anything like the ones that we were used to seeing in the last 30 or 40 years. I mean, one way of thinking about it is each peak in the Fed funds rate turns out to be materially lower than the last. And, I think this one is looking as though it, when you look at it on a chart, it may even be hard to see.
Yeah.
In other words, the sort of hikes that the Fed may have to do in the next year or year and a half might be very, very muted compared to not just history, but also, for example, compared to what the Fed itself expects. I mean, if you actually look what's priced into markets now, at least it changes obviously day to day, but what's priced into markets is the Fed will barely do more than another 1.5 this year.
Right.
And so, clearly there's almost a credibility issue for the Fed. I think some of that just is a function of near-term market turmoil. And let's assume that goes away, although maybe that's a bit bold, but let's assume it goes away in the next few weeks. I think the Fed will be back moving at some point, possibly June is the next likely move based on current conditions. Not the least of which is because although inflation is low, it does appear in some important areas like service price inflation to be ticking up a little bit. But I think the big worry that we've got, and Dr. Rhee kind of alluded to it, is this issue that, with the Fed being so expansionary and all other central banks being so expansionary, the fact that we're seeing so little in the form of growth, I think worries people that monetary policy in some sense is no longer as potent as it used to be. Certainly on the upside, and you could say potentially also on the downside in terms of its ability to save us in the next downturn. And in fact, the most potent aspect of monetary policy these days seems to be the competitiveness effect through the exchange rate. And in the old days, we used to think of that as something that small open economies like Korea would enjoy, but everyone else, like Japan and the US especially, was less relevant for them. But now it seems to be relevant for everyone, and everyone seems to be wanting to pursue that route, which, of course, the way I look at it, at least, is something of a zero-sum game. So I think this year, this year, and the year after could be, a worrying period, both because the Fed is tightening, but also because I think markets will increasingly worry that central banks are sort of out of, their power is somewhat diminished.
Yeah. If I could just explore this a little bit more, turning it into the global outlook. One line of argument, I think Michael Spence takes this, is that the low interest rate, this easy monetary policies is bad for business investment and bad for growth. There's uncertainty over monetary policy course that leads to greater investment in financial assets because they're more liquid than real assets, and then this demand for liquidity dampens investment. There's several other chains in this, but do you see this long period of easy monetary policy as a hindrance to supply side or to growth, whether it comes from the supply side or demand side?
I think the major contribution of this monetary policy in the past 5 years after the 2008 is a financial stability rather than growth, because it's an emergency period and the crisis period. So actually, in that sense, I think they contribute a lot.
Okay.
But the low interest rate is combined with in Larry Summers' term is secular stagnation fear. So I think it's understandable that in this period, even though interest rates are quite low, but there's not much appetite for the business investment. So that was a kind of puzzle that we had, right? Because even though this monetary policy has been quite excessive in the last 6 or 7 years, we didn't see the business investment is really picking up. So we can understand, but still, as Mr. Suttle mentioned, this really shows the what monetary policy can do and what they cannot do. What they can do is, as a land of last resort, they really save the financial market. But when we really want the real growth, we in the textbook we say monetary policy is good for short-term stabilization, short-term stimulus, but we don't know whether the monetary policy, if you have a theory, is more like neutral, right? So that is a real issue now, whether with the monetary policy we can have real growth. The answer seems to be negative, so that's what people are worrying about. And from an Asian's point of view, one issue, as you mentioned, is now we are more concerned capital outflow. In all the last 5-6 years, there's a capital inflows coming in, and many Asian economies, to maintain the relatively high growth rate, they leveraged a lot. And in Asia overall, especially in China, leverage ratio increased quite significantly. Now when normalization starts, we believe that it should be gradual, and it will be gradual. But still, it depends on the expectation of the exchange rate movement or others, and the interest rate differentials, how much capital will outflow, and how much depreciation pressure will come in. And together with that, how much competitive depreciation will happen among emerging economies. And those concerns is related with a country with some FX denominate that can be vulnerable. So this is time that when you rewind these things, and these issues become real, even though I have to say that compared with other emerging economies, many Asian emerging economies and Asian countries are much better shape than 1997, and as well as other emerging economies. But this issue becomes important issues.
Right. They learned the lessons of 1997 and probably don't want to go back to the IMF again, right?
Oh, no.
Well, the other way of kind of generalizing this issue is that everyone learned the lessons from their crisis in a rolling way. And that lesson is, I'm going to be very conservative and build buffers. And, it started in East Asia, it then spread, with a bit of a lag perhaps to parts of the developed world, most especially to Europe, but then more recently into the United States. Japan obviously was all part of it as well. And I think, the worry is that, an increasing proportion of the world wants to raise its saving rate, wants to raise liquidity buffers, wants to raise capital buffers.
Right.
And it's the classic Keynesian sort of fallacy of composition problem that if everyone's trying to save their way to prosperity, you end up with a very weak global aggregate demand picture.